Welcome back to Rockstock Channel. It is Wednesday, September 24th at 10 o'clock, and we're here to talk about a new initiative at RK Equity, which are these blogs that Matt Fernley is writing on RK Equity's website at blogs.rkequity.com. There are two new ones. We spoke about the rare earths one uh, in our last Rockstock recap, which had Craig Shesky of the Metals Company and Ernie Ortiz of Lithium Royalty Corp on. And today he's going to talk about an aluminum blog he wrote, and as well as one about recent policy moves in China. Before doing that, though, I do want to comment about a tweet I just put out talking about, is Lithium Americas about to have its MP moment, MP materials moment, and will this benefit broader lithium sentiment and valuations as it has in rare earths? I would encourage you to follow me at Lithium Ion Bull. We'll flash this up here, but Lithium America stock is up 80%. A number of other lithium stocks are up quite a bit, especially U.S. listed and U.S. project ones like Ioneer and Anson Resources, on the back of the prospect of the U.S. government potentially taking an equity stake in Lithium Americas, which when they did that with MP, as well as with Intel, those stocks, performed well. So there's a fair bit of nuance here. Lithium Americas put out a press release that they are negotiating with the government. We don't know what the terms are. There is the market's, maybe it's short covering. There is some skepticism that maybe the government is going to take something for free here away from minority shareholders. That's not my view. I think the prospect of a win-win-win public-private partnership narrative, similar to what happened with MP, might be on the cards. We'll have a lot more to say about that when we record our next Rockstock recap, which will be on Friday. Just wanted to flag that because it's very timely and current. So with that, Matt, welcome back. Which one do you want to talk about first, the aluminum or China?
Let's talk about the aluminium, or aluminum as some people refer to it. And interesting topic. Aluminum has obviously been a complete dog over the last 20 years. And I'm sure that there's a lot of people who look at the mining industry who are sort of looking at this podcast and going, what the hell is he talking about? Because so many of us have had our fingers burnt on aluminum over the last 20 years. Everybody's always expecting it's going to turn that corner. And I genuinely believe structurally it actually already has turned that corner, but the market is not seeing it. And potentially with the demand story to come through from the solar industry, from the cabling associated with the energy transition, the addition of renewables in many regions. I think there's a really strong demand story coming through for aluminum and a constrained supply environment. So I guess if we just start at the beginning, one of the things that created aluminum in the mid-noughties was China's export behavior. So we had a situation in China in the early noughties whereby there was a lot of stranded power. And to take advantage of that stranded power, they built a large amount of aluminium smelters because I lapsed again. Aluminum smelters, because power is a major constituent of aluminum production. That resulted in China basically switching from a fairly significant net import position in aluminum to a fairly significant net export position, which actually grew over the next sort of 10 to 15 years to such an extent that it basically sunk a lot of medium and high cost aluminum capacity in the US, in Canada, not to the same extent in Canada, but certainly in the US, in Europe, and in other countries. And it's really pushed a large amount of the traditional aluminum producers out of the market over that time. And this overproduction obviously had the impact that it lowered aluminum prices considerably. And we talk about the aluminum copper ratio in the blog, and I just talk about the fact that it was actually very strong in the early noughties, absolutely cratered sort of roundabout sort of 2003, 2004, and never really recovered back to the previous levels it had been at. Now, what we're seeing out of China is a very substantial change in production. The Chinese government, as we're seeing in a number of critical material sectors at the moment, has clearly turned around to the industry there and said, look, we do not want to be utilizing our finite natural resources, which is bauxite as well as power, in overproducing material and dumping it elsewhere in the world. So we're installing a production cap on aluminum production, and you're not allowed to go above that level. Now, that's quite a substantial change because China has contributed something like 83% of aluminum supply growth over the last 10 years. And if China now stops growing its supply, that's going to leave quite a considerable gap in world balances. Potentially, we could see supply coming out of Indonesia and out of the Middle East, but not enough to replace the supply that we're going to lose from China. And then you add that in with the potentially significant secular demand that's coming through. And I think, you talk about secular demand in base metals, and everybody will talk about copper. They'll talk about how much copper you've got to use in solar, how much copper you've got to use in cabling, how much copper you've got to use in EVs. But newsflash, all of those users use aluminum as well. So there's a strong demand pull coming through for aluminum over the next 5, 10, 15 years with supply constrained. And actually, we've already seen the impact here. We already see aluminum exchange inventories at critical levels. So there's something like 2 to 3 days of consumption of aluminum inventories on the LME, on COMEX, on the Shanghai exchange, compared to copper, where there's about 8 to 10 days. Yet copper prices are roundly outperforming aluminum prices. So I see the potential for aluminum prices to perform in absolute terms, but I also see the potential for some performance of the aluminum copper ratio as well, which should allow aluminum to re-rate versus copper. So that's really the point of the blog.
Okay, very interesting. You didn't mention any specific ways to play aluminum or aluminium, I think, in that blog. If I have no exposure to aluminium, but I've thought about like buying Alcoa or Century Lithium. Not financial advice, but I'm sure there are some bauxite plays. Back in the day, we represented a company called Global Alumina. Guinea is a big supplier, Saudi Arabia, I guess, and the Middle East with their cheap electricity, I guess, is in the supply chain. Like, how does one start
Yeah,
to think about playing?
yeah. Both those stocks that you mentioned are good ways of playing aluminum. Also, Norsk Hydro, which is Norwegian listed, is a major player. It's integrated up the supply chain as well. If you don't mind sort of Hong Kong, there's a company called China Hongqiao. There's Chalco also that's listed in Hong Kong. And if you want to go upstream, there's a couple of interesting Australian companies. There's a company called Metro Mining that mines bauxite in Australia. And there's a company called Canyon Resources, which has a bauxite project in Cameroon. So there are some interesting ways to play it. And for me, it's an exciting and evolving space over the next couple of years. And, if I look in the mining space at the moment, there aren't too many segments that really look cheap. And this is one of them. I mean, some would obviously say, well, there's a reason it looks cheap. But I actually do think that we're seeing a structural change in the industry.
So another way to get some aluminum exposure Matt, is through our new sponsor, USCF, US Commodity Funds. And this episode is sponsored by USCF, a pioneer in commodity ETFs for nearly 20 years. Their ETFs deliver pure commodity exposure through futures contracts, often, and some equities. But one of their funds that we spoke about, and we'll flash up here our introductory interview with the CEO, John Love, was the Sustainable Batteries Metal Fund, ZSB, which provides some exposure to aluminum futures in there, as well as some stocks like Albemarle and the like. So please visit if you're interested in USCF, uscfinvestments.com. And just a reminder, please follow Matt Fernley, on X at Matt_Fernley, as well as on LinkedIn, and RK Equity at RK Equity Rocks on X and also on LinkedIn. And in addition to visiting blogs.rkequity.com to get all of these blogs from Matt, visit the main website, rkequity.com, and register your email to get the Lithium Bull monthly newsletter delivered straight to your email box. And with that, Matt, let's turn to the second blog that you wrote, which was on recent changes to China economic policy.
Yeah, there's the legislative regime, and actually, on the sound of it, it sounds like, oh, so dull. You're like, why on earth are you writing about this? But actually, it's had quite profound impacts in a number of the critical materials areas over the last sort of 6 months or so. So I just run through the sort of changes on a broad basis, and then talk a little bit more about them in detail. First of all, in June, we had an amendment to the unfair competition law in China, which is basically targeting at industry over competition. So it's relevant in downstream markets like batteries and EVs, but it's also important in upstream markets like aluminium and lithium. I lapsed again. In July 25, MIIT, which is the Chinese Ministry of Industry and Information Technology, added new energy materials to its stabilization list, so lithium in particular. And that basically is aimed at what they call curbing disorderly or irrational competition. What that means is that the leaders of various industries, including the solar, the EV, and the lithium industries, were summoned to Beijing to have their wrists slapped by the government in terms of overproduction and basically utilizing the country's natural resources to dump material elsewhere. And then the final law that's very, very important is in July 2025, the revisions to the Mineral Resources Law. These were actually announced the previous October, but we didn't realize what the impact would be until the Chinese government turned around and started going after lithium producers. And in fact, a key aspect of this law was taking the issue of licenses for strategic materials to the national level rather than the state level. And this is the law that has resulted in the issues with the CATL mine in Jiangxi province. Potentially, it could also have issues around end-of-life management of rare earth mines in southern China as well. So it's very, very important. In addition to this, China has got on the bandwagon with identifying strategic and critical minerals. It hasn't published its list personally, but we understand that rare earths, antimony, gallium, germanium, and lithium are all included on the new list, which will be an area of focus for the Chinese government in terms of how its mining industry works from now on. And then the final issue, which is very, very important, is changes to the rare earth production quotas out of China. Basically, the background for this is that over the last 7, 8, 9 years, the Chinese government has issued production and export quotas and smelting quotas for rare earths. Generally, they make these public. In 2025, they have not done so, since rare earths have become very much a geopolitical material. But what they have done is they have now included rare earth concentrate imports in the production quotas. So we estimate that something like 30 to 50% of global heavy magnet rare earth supply is processed in China, having been imported from Asia. If that is now included in the production quotas, that could substantially lower the amount of rare earth oxide material and rare earth metal material that Chinese miners and processors would be able to meet to make within their quotas. So that could tighten up the rare earth market considerably, and I would contest that that is the reason why the Shanghai NdPr and magnet rare earth prices have increased over the last couple of months, and not necessarily the decision by MP Materials to cut off exports of concentrate to China. So potentially going forward, these changes to Chinese mining legislation could have substantial positive impacts to critical materials prices and hence to equities.
Thanks very much, Matt, for this quick summary of your blogs. As I mentioned before, please tune in to our Rockstock recap on Friday, which will be covering lithium and many other stories, as well as some new interviews that we're going to be recording shortly. Speak soon.